Namaskar friends, welcome to the ABM Crash Course day number 2, and in this lecture we are going to discuss our unit number 18 important points, which is based on analysis of financial statement. So as we have done in the lecture number 1, our main motive of this crash course is to make our concept clear, see only those topics which are important from an examination point of view, and practice more and more MCQs and case studies based on them. So after this session I request you to please go through the MCQs PDF or quizzes which I have added in today's folder. Please go through them. So now let's get started. So the first topic is understanding the financial statement. Have you ever wondered how business keep track of their financial health? Let's break it down into 5 essential components that form the backbone of financial statement. The first is called balance sheets. So friends, think of this as the financial snapshot of a company. It shows what a company owes, that is called asset, and it shows what a company own, right, that is called so what a company own, what a company own, that is called asset, and what a company owe, that is called liability, right. So at a given point of time it shows the assets and liability of a company, that's called balance sheet. The second kind of financial snapshot we have is called profit and loss account. So the ultimate performance tracker. This statement details revenue, right, it details expenses, it details your revenue, it details your expenses, right, whether the business is making profit or whether it is making loss. The third statement we have is called cash flow statement. So it simply means money in, money out, right. So this statement track movement of cash, ensuring business have a smooth liquidity to run smoothly. The next statement we have is the statement of change in equity. So ever wondered how ownership equity shift? So friends, this statement explains how the owner stake in the business changes over time due to profit. It explains how ownership stake changes over the time due to profit, due to losses, or due to investment. So how the ownership equity changes over the time due to profit, losses, and investment. And the last we have is the explanatory note, means the fine print that matters. These notes offer additional context, additional detail, helping investor and a stakeholder understand the number better. So each of these component is like a link in the chain, interconnected and crucial for financial decision making. Now I hope this 5 kind of components of financial statement is clear to you. Now the next thing we have to study is the role of financial statement. So friends, financial statement are more than just number. They impact key decision maker. So here we are talking about some key decision maker. Who are the key decision maker, right? So let's dive into their role. The first is lender. Lender is before granting loan, bank and financial institution analyze financial statement to assess the company financial health, right? So it based on company financial health. Second, is called creditor. So creditor is the supplier, creditor is the vendor. So whenever you see this word creditor, it simply means the supplier, it simply means the vendor, right? So they checks a company credit worthiness to decide whether to extend credit or demand upfront payment. The next is investor. Investor means investment is all about trust and potential. So whenever I say investment, it's about trust, it's about potential. So investor analyze financial report to determine if the business is worth funding. Then we have government body. So regulatory authority, they ensure financial compliance and transparency. So regulatory compliance means financial compliance and transparency. So they prevent fraud, they maintain economic stability. Then the next stakeholder we have is none but the rating agency. What is the role of rating agency? So friends, business rely on a strong credit rating. So every business rely on a strong credit rating, right, to attract funding, to maintain credibility in the financial market. Then we have customer. That stability always matter. So consumer prefer financially a strong company, ensuring trust and long-term reliability. Then we have employee. Job security and company culture are directly impacted by the firm financial standing. No one want to work for a company which is on a brink of collapse. And finally, analyst, experts. So expert interpret financial data to provide valuable insight, guiding business and investor forward a smarter strategy. So financial statements are like the backbone of a business transparency, backbone of the business trust. They help business grow, right, and they help investor invest and economy thrive. So that is the importance of this financial statement. Now let's look at the foundation of the financial statement preparation. So friends, have you ever wondered how financial statement maintain accuracy, consistency, reliability. So they are built on a strong accounting principle that guide business toward transparent financial reporting. The first principle is called accrual and matching. Imagine recognizing revenue only when cash is received. Only when cash is received. Right. So imagine you are doing that. So that would not reflect the true picture. Right. The accrual and matching principle ensure that revenue and expense are recorded accurately when they occur, not when cash is exchanged. So whenever revenue and expenses occur, they have to be recorded only then. That is called accrual and matching. The second principle is called prudence and conservatism. So accounting is not about being optimistic, it's about being realistic. So this word realistic, let me write it down. This word realistic plays a dominant role, right? So this principle ensures that business prepare for possible losses while not overstating gain, promoting cautious financial reporting. The next point we have is called a stable monetary unit and accounting period. So to compare financial performance, consistency is the key. So here is the key word is consistency, right? So this principle ensures that financial statement use a stable currency and follow fixed reporting period, making analysis meaningful over the time. Then we have going concern and separate entity. So a business is assumed to operate indefinitely unless proven otherwise. Plus a company finance are separate from its owner, ensuring business continuity. So it ensures, it ensures business continuity, right, and independency in the financial record. Then we have consistency, cost, and finally money measurement. So financial reporting should follow uniform standards so that a statement remain comparable across times and company. Costs should be recorded based on their actual value, avoiding misleading and inflation of asset. And then we have dual aspect, realization and full disclosure. So every financial transaction affect at least two account, right? One is called debit account, another is called credit account, right? Keeping balance intact. Moreover, full disclosure ensure that all relevant financial information is transparently reported, leaving no room for hidden surprises. So these are the accounting principles which are the backbone of financial statement and ensuring preparation, ensuring accuracy and transparency. So I hope it is clear. Now let's look at the breakdown of the financial structure. Ever wondered how a company financial structure is organized? Let's break it down into four key components, each playing a crucial role in the company financial health. The first is called shareholder fund. This is the backbone of company financial strength. Why? Because it includes share capital. It includes share capital, reserves, surplus, share warrant, all representing the owner stake in the business. All of these represent the owner stake in the business. The stronger the shareholder fund, the more financially stable the company is. Then the second part we have is the share application money. So before share are officially issued, investor deposit fund. What investor do? So investor deposit fund, right? So before the share are issued, before the share are officially issued, investor deposit fund, which are temporarily classified. So these funds are temporarily classified as share application money. This represent the commitment of potential shareholder before their ownership is finalized. Then we have something called non-current liability. So think of this as the company long-term financial obligation. It includes, non-current liability includes loans, it includes bonds, it includes other borrowing that the company must repay over several years. Managing them will ensure business sustainability. Then we have current liability, right? So these are the short-term obligation that a company need to settle within a year. So less than or equal to 1 year, right? From supplier payment to short-term loan, these liability must be managed efficiently to ensure smooth operation. So a well-balanced financial structure is essential for business success. Proper management of equity, security, liability ensure growth, stability and investor confidence. So friends, this is how we are learning in our crash course. So basically I am providing you videos like this. After going through this video, which hardly take 20 to 30 minutes, you go to MCQ solving and quizzes solving. You devote maximum time there. You see your performance, whether you are able to get 60% marks or not. If not, you again read the topic, right? So this way you on daily basis you prepare and you basically become more confident. You check your strength, you make your strength, you convert your weakness into a strength, and this PDF will be available for download purpose. So at the time of revision, you can just go through the main points and you are able to revise. So if you want to be part of this crash course, just WhatsApp me on this particular number and I will make sure that each and every concept is clearly understood to you, right? So now let's continue our discussion and let's talk about further topic. So the breakdown of company asset. So friends, every business rely on asset to operate smoothly, to grow, but not all assets are the same. Let's break them down into two components. The first is called non-current asset, the second is called current asset. So these non-current assets are the long-term resource. So as the name suggests, they are basically long-term resource that company hold to generate revenue over the time. So you can think of some example like land, like building, right, or machinery, or patent, right, or investment that won't be converted into cash anytime soon. So these assets provide stability and help the business grow. Then we have the second type, which is called current asset. So these are the short term resource. So if we talk about the current asset, these are the short term resource, right, so that a company expect to convert to cash soon. So basically these are the short term resource that company expect to convert to cash. This can be converted into cash soon. Example include cash, receivable. So let me give you some example of it. Cash, receivable, right, and there are some inventory is also an example of current asset. Short term investment. So the higher the current asset, the better a company can manage its daily operation. So a strong balance between current and non-current asset ensure financial stability. Now let's look at the purpose of comprehensive financial analysis. This question was asked in the December examination. So friends, a company financial analysis health is like a puzzle, and banker analyze every piece carefully before making lending decision. The first thing they do is to assess the performance. What does it mean? So the first step is evaluating the growth, evaluating the profitability, right, and overall financial health of the company. A strong performance means a lower risk for lender. So try to understand this point. So if performance is strong, it simply means that lower risk is lower, right. Then second thing we have is projecting the future earning. So banker forecast future financial outcome based on past trend, right. So this help predict future financial outcome based on past trend. Then the next thing is ensuring proper fund utilization. So it is crucial to monitoring how bank fund are being used. Are they failing growth or being mismanaged? Banker check this closely. Then evaluating the credit worthiness. So before approving a loan, bank gauge the company reliability and risk factor. So a strong financial track record simply means higher chance of approval. Then we have detecting the financial distress. Early warning sign of financial trouble can prevent future loan default. So banker identify risk before they escalate. And the final point we have is verifying the financial accuracy, as you can see. So it means that number don't lie, right. So number don't lie, or do they? Banker cross check financial statement to ensure they are accurate, they are reliable. A single mistake can change everything. So a thorough financial analysis ensures safer lending, better investment, and a stronger financial system. So now let's look at the next point. Let's look at the balance sheet, how it look like. So friends, have you ever wondered how banker analyze a company financial position before approving loan? It's all start with a balance sheet, which is like a financial mirror of a business. A balance sheet summarize assets and liability, helping credit officer determine the company's solvency, liquidity, and financial stability. What does liability mean? Liability means the source of fund, and asset means the use of fund. So it includes liability includes short term liability, right, which includes working capital finance, or current liability, which is called OCL, other current liability, and it also includes long term liability, right. Short term liability is long term liability, right. So this thing must be clear to you. It includes short term liability, it includes long term liability, and also net worth. So you can see tangible net worth. So tangible net worth means company owned fund, including paid up capital, including capital reserve. So let me write it down. Owned fund includes paid up capital, plus capital reserves is there, plus surpluses are there. So these things are included in the tangible net worth. Now asset side represent how the fund are used. So asset represent usage of fund, right. So it simply represent usage of fund. So basically there are some short term use. So fund can be used for short term, like current asset, total current asset, which is called TCA, which includes cash, which includes receivable, right, which includes inventory. So these are the total current asset. You must know it. Cash, receivable, inventory, these are the part of the current asset. Then there is something called net working capital, NWC. So please look at this balance sheet, and I will make you understand each and every part. So the first part of the asset you can see is the total current asset, which includes cash, inventory, and just now we have talked about receivable. The second part is called NWC, net working capital, means the buffer between current asset and current liability is called net working capital. So we can say it is current asset minus current liability. The buffer is called net working capital. And then we have some long term use. You see the long term use. So the short term use, it includes two parts. Short term use includes total current asset and NWC, and long term use, it includes fixed asset. So it investment in the fixed asset, investment in the non-current asset, right? And so ensuring business growth. So in the liability side, we have seen there is something called short-term source of the fund. So it includes working capital which you have availed, right, and other current liability, two part of the short-term source. And the long-term source, we have two part, net worth, and we have total total long-term liability, which is not a TL. So this is the proper bifurcation of this balance sheet. I hope it is clear. Short term use, long term use. Question may be asked, which of the following is a part of short term use? So you must answer. Which of the following is a part of short term source? You must answer, right? So this chart should be clear, this table should be clear, right? So it helps determine whether a company is financially sound and can repay loan without a stress. A balanced structure of assets and liability ensures sustainable business part. Now, any imbalance may signal financial distress, triggering red flag for lender. Now, let's look at this slide. Ever wondered how business evaluate their financial health? The right financial analysis method can uncover insight that can drive smart decision making. Let's explore the top 3 methods used by financial experts. The first method they use is called fund flow analysis. Tracking where the money comes from, where it goes. This method help in assessing liquidity. It help in assessing liquidity, right, and ensure a business has enough fund to operate smoothly. So the maxim is that no liquidity, it means that if there is no liquidity, it means no growth. That's it. So it assesses the liquidity, right? It assesses the liquidity and ensure that a business has enough fund to operate smoothly. This is called fund flow analysis. The second kind of analysis we have, is called the trend analysis. So pattern don't lie. So here the point is, pattern don't lie. This method helps identify the financial trend over time, allowing business to predict future performance and make data driven decision. So the key point here is data driven decision, right? A sharp decline means a time to act. And the third thing is called ratio analysis. Numbers tells a story. By comparing financial ratio, companies assess profitability, efficiency, stability. It's like a health checkup for a business. The right ratio means financial fitness. So these are the three methods which we use for financial analysis. Now let's look at financial analysis overview. So friends, have you ever wondered how business decode their financial health? Let's break it down into 3 essential methods that help in decision making. The first is called the common size statement. So number means nothing without context, right? So number, it means nothing without context. Context is very important. So this method standardizes financial data, making it easier to compare company of different size. Want to spot trend? Start here. There's something called trend analysis. I told you earlier, right? Financial pattern tell a story. This method help track movement over the time. So basically it help track movement over a time, right? So it allow business to predict future performance, avoid surprise, a must have for smart decision making. And finally we have fund flow analysis. Where is the money going? This method traces the inflow and outflow of fund, ensuring liquidity, ensuring stability. A business without cash flow is like a car without fuel, right? Now let's look at the next slide. So this is the financial analysis overview. Just now we have talked about. Let's look at the next slide. So ratio analysis. How do we do the financial health assessment? Through ratio analysis. So first thing first, that ratio analysis is not just about number. It's about understanding the financial heartbeat of a company, right? It's about understanding the financial heartbeat of a company, right? So where does your business stand? So let's break it down into 4 key financial positions that every business fall. So first, stable but unprofitable means what? It means a strong liquidity, right? A strong liquidity but low profitability. This means company is financially stable but not generating higher profit. So a business that plays it too safe might miss on big opportunity. Second is a strong financial position. High profitability, high stability. This is the dream scenario. A company with a strong profit and solid financial footing is set for long-term success and growth. Then we have financially strained, means low liquidity, low profitability. You see, low profitability, low liquidity, right? A business in this state struggle with both profit and stability. And finally we have profitability but risky. So high profitability, low stability. So big profit might seem great, but without financial stability, it's like walking on a tight rope. One wrong move and the business could face serious trouble. So balancing risk and reward is the key. Right. Now let's look at some ratios. So I hope the ratio analysis concept is very clear to you. What is the importance? Now let's look at some liquidity ratio first of all. So ever wondered how financially secure a company really is? So this liquidity ratio, this liquidity ratio, it helps it hold the answer. They help us understand whether a business has enough short-term asset to cover its liability. So whether a business have enough short-term asset to cover liability, that is what it answer. So friends, let's see two key ratios. The first ratio is called NWC ratio, net working capital ratio. So it measures long-term support for current asset. It simply measures long-term support for current asset, right? So it shows the margin over liability to assess financial strength, and the formula is quite simple: net working capital upon total current asset multiplied by 100. Right. So one thing I want to show you, that this NWC and this TCA, one thing you must note, you look at this balance sheet. You please look at this balance sheet. So you can see this NWC and both TCA, both are the part of short-term liability. You see it, short-term uses, right? So a higher NWC ratio means the company has a strong financial cushion to handle its obligation. So it means that, it simply means that its NWC is higher, because this ratio put NWC in the numerator and TCA in the denominator. Right. So if this ratio NWC is higher, it simply means this ratio will be higher. It means company has more working capital available to maintain its short-term obligation. Right. And if the ratio is lower, that means that could signal a trouble ahead. So I hope this ratio is clear to you. Right. You just remember this diagram, and TCA, current asset, NWC upon TCA. Right. Net working capital upon total current asset. This is how we calculate the NWC ratio. This is called a solvency ratio. The second kind of ratio, this is liquidity ratio. The second kind of liquidity ratio is we have current ratio. I think you are familiar with it. It is nothing but current asset upon current liability. Right. It indicates short-term liquidity strength. Right. Total current asset upon total current liability. So if current ratio is higher, it simply means company can easily pay off short-term debt. But too high, it means holding excess cash instead of investing. And there is something called quick ratio. Quick ratio means quick asset upon current liability. And what is quick asset? Quick asset means current asset minus minus some inventory, which you cannot convert it quickly into cash, right? So you subtract those inventory, that will give you quick asset. So current asset, quick asset, current ratio, quick ratio. So this is all a part of the liquidity ratio, right? And understanding liquidity is very crucial. Whether you are a business owner, investor, finance student, making this ratio help, mastering this ratio help in better financial decision. Now let's look at some important ratios, profitability ratios. So friends, ever wondered how profitable a business truly is? So profitability ratio help us uncover this by analyzing revenue, cost, efficiency. So in this particular table, you will see a different kinds of profitability ratio we have. So let's get started with the first ratio we have, that is called raw material consumption ratio. Ever wondered so how you measure the impact of it measures the impact of raw material cost on total production expense. So the formula is quite simple. What is the value of raw material consumed? What is the cost of production multiplied by 100? Right. So if the cost of production is rupees 100 and raw material you have consumed is 120 rupees for rupees 120. So 120 upon 100 into 100, that will give you percentage. Then we have the next ratio, which we call PBT ratio, profit before tax ratio, right? Profit before tax. So it assesses profit before tax as a percentage of the net sale. So in denominator you will have net sale. In numerator you will have profit before tax. So a higher ratio means a strong earning before taxation. Then the next ratio we have is called PAT ratio. PAT means profit after tax. So it evaluates the profit after tax with respect to net sales, right? And then the next ratio we have EBI TDA margin ratio. It gauges operating profit relative to the sales, right? So what it gauges, it gauges operating profit related to the sale. So EBI TDA, what is EBI TDA? Earning before interest, tax, depreciation and amortization, right? So it gauges your operating profit, operating performance. So if EBI TDA is higher, it means better efficiency, better profitability. Then we have ROEC. What is ROEC? ROC means return on capital employed. So ROC simply means return on capital employed, right? So it measures how efficiently a company, right? It measures how efficiently a company uses its capital to generate earning, how efficiently a company uses its capital to generate earnings. Suppose this is the company, right? So friends, this is the capital, this is the capital. So how efficiently it is using a capital to generate earning? The formula is quite simple for ROCE. Earning is noted by EBITDA, and you know, capital is the total asset, is the asset is the capital. So EBITDA upon total asset into 100, that is the formula for calculating ROCE. Return on capital employed means it is, you know, business is investing capital, how much earning it is generating. So earning is represented by this EBITDA. EBITDA you put in the numerator, you just write this EBITDA in the numerator, that represent your earning, and you just write the capital, which is the total asset which the company has, in the denominator, multiplied by 100. This will give you ROCE, return on capital employed. And then finally we have something called operating profit ratio. So it isolate core business profitability by excluding the non-operating expense. You know, there are some non-operating expense. So it help understand how will operation generate profit. So these profitability ratio are like an umbrella, right? They protect business from financial risk and guide them towards sustainable growth. So I hope this profitability ratio you will be able to remember. I have summarized all this thing in a single line, in a single page. If you think this was helpful, please hit the like button. Then we have the next kind of ratio, which we call leverage ratio. In the world of finance, understanding leverage ratio is very crucial to understand company financial health and risk level. So the first kind of leverage ratio is called total outstanding liability to tangible net worth. So how to remember it? So I again bring your attention to this balance sheet. So please see this balance sheet which I have shown you earlier. So I am talking about this balance sheet, right? Let me show you, just wait a minute. So this is what we are talking about. So friends, you see what we are talking about, TOL, total outstanding liability, right, to the tangible net worth. So where tangible net worth is there, you see this tangible, this is the net worth, and that too tangible net worth. And you know, total outstanding liability, right, total outstanding liability. So it includes all terms liability, all current liability, it is also included. Current liability is also included. These two are also included. And you know, tangible net worth represent net worth minus intangible asset. So from this net worth you subtract the intangible asset, this will give you the tangible net worth, right? So this is called TOL upon TNW. If this ratio is lower, it means a strong financial position. It simply means a strong financial position, right? TOL upon TNW is lower, means outstanding liability is lower, it means a strong financial position. So this is a kind of, you know, this is a kind of a leverage ratio, right? This is a kind of leverage ratio, TOL upon TNW. Please remember this ratio, very very important, right? Then and what is TNW? I told you. The next kind of ratio we have DER, debt equity ratio. So it shows how much debt a company used to compare to equity. So if this ratio, so it is simply debt upon equity. So if this ratio is higher, it means, you know, riskier financial structure, and if this ratio is lower, it means more stability, lower risk. Now there is something called DSCR. DSCR is called debt service coverage ratio. This, you know, from DSCR there is a numerical question asked every year, very very important. So you know, the DSCR, there are two kind of DSCR, net DSCR and gross DSCR. If we talk about the net DSCR, it focuses on cash accrual. So you will see in the numerator what is written, cash accrual is written. What is the meaning of this cash accrual? So cash accrual means net profit, cash accrual means net profit plus non-cash expense like depreciation. You know, depreciation is a kind of non-cash expense. It is an expense but non-cash expense. So cash accrual means net profit plus non-cash expense, right? And in the denominator, this is put in the numerator. In the denominator we write total installment due. So cash accrual divided by total installment, this will give you the net DSCR. And if we talk about the gross DSCR, it evaluates the true repayment ability, including interest payment. Interest payment is also included. So it adds interest to both numerator as well as denominator. So you see, cash accrual plus interest payment upon total installment plus interest payment. So interest payment is added to the both, right? So for a more accurate picture, so it is essential for credit analysis and lending decision. So you must know how to calculate DSCR, right? A strong leverage ratio and a healthy DSCR ensure financial stability and a smart borrowing decision, right? So that is the role of DSCR, and you know, I hope it is clear, net DSCR and gross DSCR, and which gives you a better financial picture. I hope it is clear. Now let's talk about the so-called coverage ratio. So till now we have discussed liquidity ratio, we have covered what we called profitability ratio, we have covered leverage ratio. Right now let's cover the coverage ratio. So when it comes to assessing a company ability to manage its debt, so the key point is managing debt. a company is able to manage the debt or not. When it comes to company, assess the company ability to manage its debt, two key coverage ratio comes into play. But which one is more crucial? Let's break it down. The first kind of ratio is what we call, it is called Vanquish ratio. It tells us, it determines long-term debt repayment estimate, long-term debt repayment time. It tells us how many years it will take to clear long-term debt using EBITDA. Means how many years will it take to clear whatever long-term debt we have taken. How many years it will take to cover the long-term debt using EBITDA. Means it simply tells you that yes, this much year it will take. So the formula is quite simple. It says that you just write this long-term debt. We are just talking about the debt, not talking about the equity. You just write the long-term debt in the numerator and you just write EBITDA in the denominator, right? So it gives you the Vanquish ratio. This question was asked frequently. Now let me give you the implication of it. See, if the ratio is lower, suppose the Vanquish ratio is lower, so what does it mean? It means that faster debt clearance. Yes, it means that if this ratio is lower, it means it will take less time, right? And if this ratio is higher, it simply means debt burden is heavy, right? Heavy. The second kind of ratio we have is called interest coverage ratio. It evaluates a company ability to pay interest on its borrowing. Yes, correct. Try to understand. So interest on the borrowing, because the name itself suggests interest. So whenever you borrow money from bank, you have to pay interest. Similarly, a company has to pay interest. So how efficiently company is able to pay interest on the borrowing, it is measured by something we call ICR, interest coverage ratio. The formula is quite simple. We write EBITDA in the numerator, and you must remember that in the case of Vanquish ratio, what we have written in the numerator? Long-term debt. But in this case, we are writing EBITDA in the numerator, and we divide it by interest expense. How much interest we are paying, right? So if this ratio is higher, it means a strong financial health. Means that it can easily cover interest payment, right? And if this ratio is lower, it means there is a chance of default. Means trouble in making interest payment, right? So the ratio can be higher, the ratio can be lower. Higher ratio means that in EBITDA is higher for per unit interest expense, right? So means a strong financial health, we can easily cover interest payment, because everything depends on earning. Obviously, if our earning is higher, we can easily cover our interest expense. So that is why this interest coverage ratio should be higher and this Vanquish ratio should be lower, right? Vanquish ratio formula is long-term debt upon EBITDA, and interest coverage ratio formula is EBITDA upon interest on all borrowing. So tell me, which ratio do you think is more important for financial stability? Is it Vanquish ratio or is it interest coverage ratio? Now let's talk about the next kind of ratio. We have fixed asset coverage ratio and security margin coverage ratio. When assessing a company financial security, so here the key point is financial security. This is the key point. So while assessing financial security, two coverage ratio comes into play. The first is called fixed asset coverage ratio, FACR. It measures asset security for loan. Right? So tells us how many times fixed asset can cover outstanding term loan, right? How many times fixed asset can cover outstanding term loan. The formula is quite simple. You just find the WDV, written down value of fixed asset, right, under charge. What is the written down value of the fixed asset? There is something called written down value, right? And you divide it by the outstanding term loan. Obviously, on that fixed asset you have taken a loan. So whatever outstanding term loan is there, you divide it by them. So basically it tells you how many times fixed asset can cover outstanding term loan, right? So if this ratio is higher, it means a strong asset backing, means loans are well secured. That means the written down value of the fixed asset is larger to cover the outstanding term loan. And if this ratio is lower, it means risky. Yes, asset may not be enough to cover the debt, right? So that is called, obviously, try to understand. Security, whenever bank give loan, it takes some collateral as a security, and this is nothing but a fixed asset. Like for house loan, it takes mortgage of the house, which is a kind of fixed asset. You know it very well, right? So if this WDV is higher, it means this ratio is higher. It means we have sufficient asset to cover the outstanding term loan, right? So if there is a strong asset backing, it means loans are well secured. And if this ratio is lower, it means this is a risky situation. Means asset may not be enough to cover the debt. The second kind of ratio we have, is called security market coverage ratio. You know what it is? It assesses the financial cushion available, right? And the formula is quite simple. You write down the WDV of fixed asset, you subtract the term loan, let me write down the formula. This is very important. You write down the WDV of fixed asset, you subtract the term loan outstanding, and you divide it by WDV of fixed asset. So basically, sorry friends, basically we are comparing term loan outstanding with respect to WDV. So if this ratio is higher, it means more financial stability, means greater asset coverage ratio after debt. And if this ratio is lower, it means limited buffer, higher financial risk. So you know both the ratio, either we call it FACR or we call it security margin, because you know this word is margin. What is the meaning of margin? This way you can remember. See, there is something called WDV of written down value of fixed asset, and there is something called, so this is the security which we have taken, and there is something called outstanding term loan, like for housing loan, whatever term loan is outstanding. So the difference is called margin, right? So if this margin is larger, it means this ratio will be larger, right? So you know that is why, so if this ratio is higher, it means we have more margin, more financially stable we have. The WDV of financial asset is more, right? And with the margin is lower, it means we are in a risky position, right? So I hope this makes sense to you. Now let's switch our focus to the next kind of ratio we have. There is something called, you know, raw material holding ratio. Try to understand it very clearly. So you know, efficient inventory management is very crucial for business success. So let's break down raw material holding ratio and its key component. So the first component, you know, is called the day of stock coverage. Indicates how long the current stock will last. So obviously if longer coverage is there, if long coverage is there, it means smooth operation without supply issue, and if short coverage is there, it means risk of stock out. Then the second part aspect of it is called raw material average stock. It represents the average inventory held over the time, average stock held over the time. It helps in tracking stock efficiency and minimizing the waste. So after analyzing both of these, the third part we have is the raw material consumed, right? So basically measure the total raw material used. So finally we have the ratio that is called material holding ratio, raw material holding ratio. So right, so it represents the average inventory held over the time. So in the numerator you will see the raw material average stock, in the denominator you will see how many raw material consumed in the period into 365. So right, so a fine balance between holding too much stock, right? If we hold too much stock, what will happen? Cost will be higher. And holding too little, so if we hold too little, production will get delays, right? So the balance between holding too much stock and holding too little is the key to the business efficiency. So optimizing this raw material holding ratio ensure cost control, steady production and efficient operation. You see the numerator. Numerator means how much stock we are holding, right? So if you are holding too much stock, our cost will be higher. And the numerator you will see raw material consumed in this period, means you know this is called how much how much consumption is there. So this holding ratio is very important, right? This is called raw material holding ratio, RM holding ratio. The second kind of ratio we have is called SIP holding ratio and FG holding ratio. Let's understand these two. So which inventory ratio should you focus on for operational efficiency? So efficient inventory management is key to a smooth production and sales growth. There is something called SIP. What is the meaning of SIP? SIP simply means a stock in process holding ratio. It measures average time raw material stay in production before turning into fixed goods. And the formula is quite simple, that you write a stock in average stock, stock in process, SIP average stock in the numerator, you write cost of production in the period in the denominator multiplied by 365. So it helps optimize production time management, it reduces bottleneck in the manufacturing process, and it ensures that a steady flow of good to meet the demand. Now there is something called finished good. FG means, you know, FG means finished good. So finished good holding ratio. It evaluates how long finished product remain in inventory before they are sold. So you write finished good average stock in the numerator, cost of sales of period in the denominator multiplied by 365. So it improves sale efficiency and inventory turnover. It helps avoid overstocking or stock out. It keeps cash flow healthy. So for a business, both ratio are very crucial. If this SIP holding ratio is higher, if this ratio is high, so it means slower production and there is a possible delay. And if this FG ratio is higher, it means slow moving stock, potential loss. So balancing both ensure efficient production and a faster sale, right? So we have discussed three kind of ratio here: efficient inventory management, raw material holding ratio, SIP holding ratio, and FG holding ratio. Now there is something called receivable holding ratio. You know, managing receivable efficiently is the key to managing cash flow and financially stable. You know what is the meaning of receivable? Suppose you have a company, right? Suppose you have a company, right? And you know you have given a product just on credit to someone. You have not received the amount yet, and that is called receivable, right? So how long do you sell stay unpaid? That is called receivable. How long your sale stay unpaid? So managing receivable efficiently is key to managing cash flow. So how do we measure it? There's something called receivable holding ratio, average sundry debtor. So it represents the average amount owed by the customer, how much average amount they are owing by the debtor. So high debtor means slower collection. So simple it is high debtor. So debtor increase, it means collection will be slower, and this will be cash crunch, risk will rise. There is something called gross sale. Gross sale means total revenue before deduction. You have not deducted anything. The total amount you have received, total sale you have received, called gross sale. Higher sale don't always means better cash flow if payment are not collected on time. So suppose your sales are higher, your gross sale is very high. So it does not mean that you have a better revenue, better cash flow if payment are not collected on time. And there is something called time frame. It indicates how many days sale remain unpaid. If there is a longer duration, it means there is a risk of bad debt and liquidity issue. Shorter duration, it means faster cash flow. So the formula for receivable holding ratio is quite simple. You must remember the formula. You write average sundry debtor, means average level of sundry debtor in the numerator, means average amount which is owed by the by the debtor, and you write the gross sale of the period, means how much sale you have in the denominator. You multiply it by 365 to convert it into ratio. You multiply it by 365, right? Why we multiply it by 365? Because to find the gross sale per day. That is the point, right? So this tells us number of day. So basically after doing this, what you will receive? You will receive number of day. This tells us number of days, right, it takes to collect payment from the customer. How much amount they have taken? You have written in the numerator, right? And how much is the sales? That is called gross sale of the period, right? So how many number of days? It tells you the number of days it will take, right? So it just give you number of days it will take to collect a payment from the customer, right? So that is called understanding receivable holding ratio. So a lower receivable holding ratio means faster collection and a healthier cash flow, means it takes lower number of days. And if the higher receivable ratio, it is time to improve credit policy and the follow-up. So this is all about the receivable collection, right? Receivable holding ratio. Then we have payable holding ratio and inventory turnover ratio. So friends, how long you hold on to supplier payment versus how fast you sell inventory. So on one side we have the payable holding ratio, means average level of sundry creditor. Now suppose you have taken something on credit and you have not paid yet, right? So this tells us how long we take to pay our supplier. So just we write the average level of supply creditor, sundry creditor, and you just write purchase during the period, multiply by 365. So if the longer credit period is there, it means greater for cash flow, but delayed payment may affect supplier relation. And if the shorter credit period is there, it ensures goodwill but can put pressure on working capital, right? On the other hand, we have inventory turnover ratio, which simply means that net sales divided by average turnover, average inventory during the same period. It indicates how quickly the inventory is sold, right? So we write net sales divided by average inventory, right? So if this ratio is higher inventory turnover, it simply means that your inventory move fast, right, reducing holding cost. Simply you can see if average inventory increase, this ratio will decrease, and if average inventory decrease, its ratio will increase, right? So if this ratio is higher, it means your inventory is being sold in quickly, and if the low turnover, it means risk of unsold stock leading to cash being stuck in the inventory, right? Because this ratio will be lower only when inventory will be higher. That is why denominator we have inventory, right? So the key point is that delay payment smartly but not damage supplier trust. Move inventory efficiently to maintain a healthy cash flow. That is the point. So I hope every aspect is clear. So now that we have understood each and every ratio, please hit the like button if you have understood every part of it, because in the small amount of time I have covered major ratio. Now let's look at the limitation of ratio analysis. Very important. So ratios are widely used to assess financial health, but relying on them blindly can be misleading. There is something called time discrepancy. This is one of the major limitation. So first thing is that ratio often require average to give a true picture. Using a single data can be deceptive. There is something called fiscal period versus single day. What does it mean? So a company financial health fluctuate. So analyzing just one point in time may not reflect reality. Second limitation is the lack of context. So overlooking the cyclical variation. Business ups and downs are not always captured in ratio. A booming quarter does not mean long-term success. We ignore the seasonal trend. What does it mean? That retailer earn more during festive season. You know it very well. So ratio might not account for such kind of trend. So this is what this ratio analysis ignore. So two drawback we have already told: time discrepancy, lack of context. The third drawback, is data manipulation. So there is something called inflating asset. Company may overstate asset value to appear stronger. Deflating liability. So lowering reported liability can artificially boost financial ratio, making business look risky. There is something called methodological flaws. So year-end sale spike. Some firms push sale at the year end just to improve their ratio. Does that really affect performance? No. Inherent ratio limitation. Ratio are just indicator, not absolute truth. They should always be analyzed alongside other financial data. So ratio help us analyze financial statement, but context is everything, right? Always look beyond the number to understand the real financial picture. So we have discussed every aspect of it: advantage, disadvantage. Now there is something called related party transaction. Money matters, but so do relationship. In business, financial transactions don't happen in isolation. They often involve related party. Who exactly are these related party? Let's break it down. The first point is control. When one entity has full control or full authority to govern policy, it holds control over the other. Think of a parent company dictating operation of its subsidiary. Second is called joint control. Sometimes control is shared under an agreement. Imagine two companies jointly owning a venture. Neither can make decision alone. Third point is called significant influence. This means an entity has the power to participate in decision even without direct control. For example, suppose a company holding 20% plus stake. 20% plus stake in another can influence its policy. Fourth is called key management personnel. These are the strategic decision maker, like CEO, like CFO, like director, right? So their decision can save the company future. And there are some entities in the same group. So that business under common ownership or control fall here. A parent company and its subsidiary are the classic example. Then we have something called associate. What is the meaning of associate? That company that are not fully controlled but have significant influence are called associate. Joint venture. This is called collaborative entity with shared control, where two or more companies work together but retain their independence. And finally, we have post-employment benefit plan. Not all related party, are companies. Employee benefit plans set up for worker also fall in this category. Now let's look at some example of this related party. So identifying related party is very crucial, right, for transparency in financial transaction. Not all entity involved in business dealing qualify as related party. So you can see some example given here, right? So you can see customer, right? Customer and supplier, despite their regular interaction, remain independent unless influence or control is established, right? So customer or supplier is not considered a related party. Remember it. A second point, there is something called trade union, right? Trade union, or we call it utilities, public utilities, government agencies, finance provider, right? Finance provider. So these people, right, and even common director do not automatically fall into this category unless they exert control or they hold significant influence. Unless they exert control or hold significant influence, they are not part called as related party. Similarly, joint venture, right? Similarly, joint venture are only considered related party if joint control exists. So understanding this distinction help in ensuring compliance and financial clarity. So friends, that's all about this particular topic. Nothing else to read. Just revise it once more. And now I request you to please go to MCQs. I have added in the folder. Please go to the quizzes. Attempt those quizzes which I have added in the folder. This is how on daily basis we will improve. This is a crash course. If you want to be part of this crash course, feel free to WhatsApp me on this particular number. I will provide you the detail. And in the description section also, you can get detail related to it.